All right, guys, welcome back to another Wise Wealth video. Today we're going to be going over the market cycle and what it is and how it moves. So, what is the market cycle? Well, it's basically just trends or patterns that occur during different market environments. So, some asset classes are going to outperform other asset classes, right? Because their business models are better to fit whatever environment is happening. So, for instance, if inflation is high and there is a lot of I'm looking for the word, a lot of like people are skeptical about the market. Well, what asset class is probably gonna outperform the market? Probably a safe haven like gold will probably outperform the market if there's a bunch of uncertainty within it, right? On the other hand, if the market is tech based and we see a high rate of growth in the tech industry, tech stocks are going to outperform, right? And this is a market cycle is basically just a period between two of the latest highs or lows of a common benchmark. So like the S&P or the Nasdaq or the Dow or whatever you want. And how do market cycles actually work? Well, they form when a trend in a particular industry or sector is developing because of innovations, regulations, or a new product. And these are known as secular trends. Now, market cycles are very hard to pinpoint until after they already happened. So you can't just say, okay, it's starting here and ending here until after the market cycles happened, right? However, you can if you do your research and you observe what is happening in the market, you can make your own choices, your own opinions. Obviously, there's no chance of being 100% correct. Nobody knows where the market's going ever. Um, but it is possible to catch on early. Obviously, you can't say exactly where it starts and exactly where it's going to end, but you can catch on early if you do your research. And based on what you think, you may be able to make investments based off of whatever the market cycle is. And a market cycle can last anywhere from 2 minutes to 20 years. It's for example, if you're a day trader, you're going to not be trading in the 20-year range because you're a day trader. You're going to be trading within minutes or hours. And if you're investing in real estate, you're probably going to look more in the 20 years, 10 years range because it takes longer for those assets to appreciate. And as a day trader, you're trading within the day, right? Now, there's four important stages of a market cycle. We have first the accumulation phase. This is the phase that occurs after the market has bottomed out or hit the lowest point. And people begin to buy thinking that the lowest point has been hit and it's only going to go up from here. The next phase is the markup phase, right? This is where the market has been stable for a while and the prices are moving higher because of this accumulation phase. And after the markup phase, we have the distribution phase, which is where the sellers are going to overpower the buyers as the stock begins to slow down in price and to reach the highest level, right? So people are going to start taking off profits. And once you take off profits, if you buy the stock at a low and you sell it at a high, right? Once you take the profits, you then have to sell the stock at a higher price than you bought it for, which is why, sellers are going to take power over buyers, right? Because once the stock goes higher, you're going to start selling your positions to make money. So at the top, sellers are going to take over buyers. And what happens with that? Well, we get the downtrend phase. And as people take off profits, aka sellers, they assume control of the stock over buyers. And when you sell, the price is going to move lower, right? Now, this is exactly how the market moves. And it's essential to know if you're going to be investing. The market, literally look at it from the beginning of when it was created to now. This is how the market moves, guys. The market will not move without this, right? So you have the accumulation, which is where people think it's the lowest. They think, okay, it's at an extreme discount. I'm buying, it's going to go up. And what does it do? It goes up, and then people sell their profits. And then once a bunch of people start selling, what's going to happen? The price is going to go down. And that's exactly all you guys need to know. And if you know this, you basically, I don't want to say know how to invest, but this is probably one of the top three most important things you have to know. Now, let's look at a market cycle graph. So where my cursor is, this is accumulation, right? So let's say, for example, the stock just came from here and it came down here. People are going to say, okay, it just came down from here. Now it's probably a discount. So what are they going to do? They're going to say, okay, it looks like a good time to buy, right? Because price is low. And the markup, you can see this is the markup. So they're going to buy, and price is going to move higher, price is going to move higher. And guess what? Once it hits around this level, people are going to start selling off, right? They're going to start selling the shares they bought down here. And what's that going to do to price? Well, it's going to push price down. So this is the accumulation where people start buying. Markup is the result of the accumulation. Then the distribution is where people start selling. And the markdown or the downtrend, whatever you want to call it, is where people sell up here and the markdown is caused by the distribution, which is when people sell and it pushes price further down. And then this cycle just repeats because look, after this, right, stock was up here and we know market moves in lows and highs, right? It goes like this. So people bought here, sold here. Now what are they going to do here? Since it's in a discount, they're going to buy here and probably another distribution phase somewhere over here, right? That's exactly how the market moves, guys. It's really not that complicated. It's honestly just also supply and demand. So go watch my other video if you haven't. But that's all you guys really need to know. Now, what's the overall of the market cycle? Well, they're essential to know when you're investing within the financial markets. You can't really invest without knowing it. And it's literally how the market moves. It's you can look at any graph and it will be exactly the same. Now, it's important not to be overly optimistic or overly pessimistic either. For example, let's go back to the chart. If you're here, right, there's multiple stages. This is probably known as the euphoria stage, which is where a lot of people bought here. The social media and the news outlets, they started promoting, or not promoting it, but reporting on the stock price, and the stock makes a very large move, very very large move, right? And people are like, "Oh my God, this is a great stock. Look how far it's going up." So they're gonna start buying here, right? Because they have FOMO. They think they're gonna miss out on a bunch of money if they don't buy. So what happens? Everybody thinks they're gonna make money, and they buy here, right? That's being overly optimistic. Now on the other side, you don't want to be overly pessimistic, right? So if it's down here, you don't want to say, "Oh my God, it's going to crash. It's going to go to zero. It's going to go to zero. Oh my God, it's all going all the way down here." Is it going to do that? I mean, 99% of the time, no. Maybe there's a couple companies that's going to do that because they're just shit companies. But anyways, um, and 99% of the time, it's going to come down. Yes, it might come down a lot, but how does the market move? It goes down and goes back up. Why? Because it comes down and people buy it in a discount. And when people buy, it pushes prices up. It's literally just supply and demand, guys. So correlate the supply and demand video with this video, and there you go. Now you guys know how to invest. But yeah, it's important to not be overly optimistic or overly pessimistic. And like I said, most of the time the market's just going to correct itself. And yes, it is possible to play off these market cycles if you play your cards right and if you do your research. Now, I want to know, where are we in the market cycle right now? Well, if we look at current events, the market's moved a crazy amount within the past like week or two. And where we are right now, well, to be honest with you guys, I think we're somewhere in this area. I do think the market's gonna correct itself within the next couple weeks or months. And honestly, I'm excited for that because I'm just gonna buy everything at a discount. Um, but yeah, that's what I think personally. I think it is going to go up more, but eventually it's going to correct itself. I don't know when. Um, Nobody can know when, but I do think it will happen within the next couple months. But that's it. I hope you guys found something informational, helpful, educational, whatever out of this video. And if you guys have any questions about this video, or if you guys want me to make a video on anything else, just leave it in the comments or send me a DM on TikTok or Instagram, and I'll do a video on it. So, like I said, guys, correlate this video with the supply and demand video. Bam, now you guys know how to invest. So, thank you guys for watching. Stay tuned for the next video.